Cash firms that are taking the future results. The opinion there of Gary from LTC LLC not taking recognition to buy or sell combined future options is based upon a teaching of Richard D. Wyckoff. So a couple of things that I want to note in the public chat room, we do have notes about an educational event that we're having and the contest that comes with it for free with the educational portion of it. And also there's various different things throughout the site. We're in the process of updating the site and just keep looking for things. If there's anything that you need to want to see via newsletter, via webinars, via mentoring, via anything of that nature, please ask us, okay? I don't want to spend a lot of time on that because I feel like a commercial, but I just want to know that it's out there and just write us. There's a live chat on the site. So go to the live chat. There are things, a lot of people do that. And please ask. If there's something that you don't understand, please write us or tell us. Michael Zan, my partner, will be happy to help you with that. If I can help with the training aspect, he helps with everything else, including that. So please write, let us communicate to us. It's the best way to do that, okay? So I want to talk a couple of things that happened, and then I'm going to kind of work backwards in markets today. So you see the stock market up very sharply today, and there's a reason for that because of the G20 summit that they had, and basically, U.S. decided not to slap tariffs on China for another 90 days. The market kind of relieved to that. One of the things that's really important to understand is that you're going to get a lot of news to come out to the markets, whether it's something with President Trump, he did this wrong, something he did that wrong, tariffs here, tariffs there. You don't have to worry about the particular news event that happened in the cycle. Wyckoff believe that the price and volume incorporated that fundamental news. Does that mean that the market can't go haywire based on news? The answer is absolutely can. So anything that can happen will happen. There's never, ever a guarantee of anything. And the market is full, you'll see a lot of volatility of markets on the left-hand side of a trading range. So there's never an always in trading. It's always very risk-filled, especially in environments because markets don't like uncertainty, and we have a lot of uncertainty. So if we understand that aspect of the lot of risk in the market, we understand the news can be a short-term shakeout or short-term move, but the campaign of the move generally stays intact. So I'm going to go over those things with you and talk about markets, and then you can see what is actually happening, okay? So, and I'll show you the composite operator, how he anticipates move, maybe not knowing what the particular event will be, but puts himself in position for a rally or for a break. Go back to 9/11, for example. The market already was breaking when the event came, and the market continued to go lower. They expected some type of particular news to happen. They got 9/11. Did they know 9/11 particularly? No. Did they know there's something that was negative happening? Probably. Or at least they were at a negative tone to the market. Okay, so hopefully that makes a lot of sense to you. If not, please feel free to ask. Okay, feel free to ask about that because it's extremely important of what I know and what you don't know and how I can help, which is one of the reasons why we're doing the educational aspect of the market, simply because we want to see, the educational process with Wyckoff, and we want to see how the markets, how you understand the markets, especially with people, the many of you that get the newsletter here, and to give you a little guidance in the newsletter and how it works with that. Before I forget, tomorrow at 9 o'clock, tomorrow at 7 o'clock Chicago time, 7 o'clock Chicago time, over members only for gold and silver members, a special webinar on money flow into the markets, okay? That's the member room. So let's go back and look at why the market did what it did today. And as you know, we go bar by bar. We take current charts because I feel that current charts are more important than past charts that may have happened for 30 years ago. We can't, or 1920. There are gaps from 1930 that probably have never been filled. So even though history does repeat itself, in this room, we want to be current to the behavior of what happens to the market. So if any of you are trading or tend to trade, you can read the current market action versus something that happened and me cherry picking an event. So let's look at this. Let's look at the week that was in the stock markets. So we went over the background of the February break and the market behavior here. So you can go to past webinars of the last several months and see where that comes in. But let's just take the current market reaction for the last 2 weeks or so, and let's see how we got to where we got here. So we have a market that essentially has some type of markdown here. So we place our order, we place our line from the supply area that came into the market. That's our resistance. Coming back down. These are not areas that we necessarily would mark because they don't show supply, but they are areas in the market has some type of reactionary high, but not selling. I would mark this bar and this bar because those are the markets that went lower, and I'd mark it like this. So that area is a very important area because it's an area that was a reactionary high. We did not make a reactionary low, but we're still in this particular trading range to the market. So we have a market that retests this resistance area, and we can see that the volume picked up a little bit. We compare the volume to the area, and we like to see the market either continue to jump higher, or we like to see the market absorb, but we don't want to see supply to come into the market. So we see the market breaking here. The market was less volume, and the market X, okay. We now see the market then break, volume increase a little bit, volume breaks because there's selling underneath this low, taking out sell stops, market continues to go lower, the market does increase as there's activity coming into the market. When we're in the middle of a range, the reaction low and this reaction high, your level of knowledge is very poor. As David Weiss, one of the best Wyckoff people out there, has said, when you, and it's true, and I guess in fishing, that when you fish at edges, not in the middle of a lake. The fish are not smart, but they're not really dumb to stay next to the boat. They stay next to the creek or the edges of the river. Edges of the river, edge of the river. The level of knowledge is poor here. Market breaks back down, compare the volume to the price range, and then we have some type of action where the market stimulated enough buying to go higher. All well and good. This market right here then gets to the point where we have decent volume, less decent volume, small range, and the upside progress was not great. That tells me effort versus result, one of the Wyckoff principles, and the market should see a little retest lower to find the demand. The market then comes back down. The market volume is a little bit higher. The range is a little bit wider, indicating easy movement to the downside, marking a negative day. The position of the close tells us that we most likely will see a retest back to this level. we will see how the market reacts at that level, and we'll see if the market does try to spring that market. A spring is a situation in which the market will go lower, underneath support, and then go back to the upside to the market. In other words, taking out a previous support and closing above it. An example of spring for new people, the market take out this low and come in here. This low and close did not create demand volume lower. In fact, increases more selling to the market, indicating that we need to go lower to find that true demand to the market. Remember, still has a retest pond area, ice area down here. Now, what happens? Bearish bar, increasing volume, indicating that selling is still prevalent. Key area, because that's where the market reacted from. So, we understand this is some type of support. This also had a reaction. This is some type of support. We don't deal in one price in Wyckoff. If somebody is accumulating a position, they do not buy a stock at 30 and say, oh, at 30 and a half, I'm not going to buy anymore. Warren Buffett buys stock at 30, he finds good value at 31. Then if he buys the market at 30 and 1/2, it represents a better value. To many traders, if the market goes from 31 to 30 and a half, they may get out because they think the market will be heading south. The CM understands the process of accumulation. He has to buy the market when the offers come to his bid in which he can buy the particular market. Important, we'll talk about bid and offers, and we're going to be doing that in this and part of the mentoring educational thing that's coming up next month. We now see the markets. Next bar here. This is over the holiday, by the way. You see the market, and sometimes holiday, the CM still does its work. So don't take it for granted that they're not. Every day the market's open, there's cause building and the potential of a market moving. Market comes down, close the middle range, volume dries out, holiday volume. Market tries to go down, holiday volume. Can't really read a lot into that, right? They can make their move, but nothing that would stand out from a standpoint of make a decision. Just because a market, this is very important, just because a market in a situation where you feel that it may be support, it may not give you the trigger to buy the market. If you see, in other words, if you see a spring of a market in a down market, yes, it is a spring, but because there's no accumulation to go higher, the spring may take the market higher, but you may not want to buy that market because the risk reward is not great. So springs tend to fail in the markets, and it's very, very important. Does that make sense? Okay, now, what is very important, what is very, very important to understand is the subsequent action after the market retests. So, what happens is this. We see the market coming back from the holiday, and we see the market begin to move up a little bit. We'll check the volume. Begins to increase. It's at Friday. Okay. We then want to mark this bar. This bar is a increasing volume. We'll draw this bar across. These high-end closes indicate short covering. This indicates some buying into the market. See the volume increase of the range. This buying, this volume overcame this selling with this volume. A very positive event to the market. A very positive event to the market. The next bar here has a clustered close, or a close that's equal with the previous close before, near the previous close. See the market now. You have volume drop off, indicating no selling from the buying. Then the market now hit. Reason why the market probably stopped here is because the market had to deal with this. The close tells you a little bit of absorption. The next bar tells you absorption because the market's higher on the same volume. You got today's gap. So today's gap should not be a surprise, or higher prices should not be a surprise, because the market all of last week, the market was building up. Okay, very important. Bring a little further. Those of you that have been in the room for a long time, you send me messages. The chat box is not on the bottom yet for the session. We kept it off the chat box because we have a lot of people in the room today, and I just want to go through this even flow of the market thought process and get a lot of things done. So we took the chat box off until the end, and then we'll have a question to answer with as well, okay? So that's why it's not there. So it's not anything you're doing wrong or anything on my end. It's just that we just took the chat box away for a little bit, okay? So thank you for letting me know. There's about 20 people that wrote me, so thank you. So we now get this gap higher. According to Wyckoff and Wyckoff principles, this gap is just part of the average true range of the market. What does that mean? Average true range is if the market had actually traded there. So this gap to here, we can basically draw a line in a sense, including that area-wise, that this is a trading market. So that's how we can see our demand for supply. Very, very, very important. And this is where we're at now. We've built cause here. Because if you take the left-hand side that happened in February, and the right-hand side that's happening now, that is one synopsis that we can consider. Or we consider this whole trading range from here and see if the market does react to the downside or does absorb the upside. We'll have to see. The market got some news today with China basically, U.S. and China basically putting off an agreement or disagreement for 90 days. I don't think, to be honest with you, it matters. I think it's a game, but the markets react very sensitively to that type of behavior in the market. But you could also see that the currencies, the Swiss franc and the yen, and we'll talk about that tomorrow in the member room, they are higher right now. And those are currencies that tend to act bullish when the stock market is lower. So even though the Dow is up an equivalent of 450 points, you can see it's in my upper left-hand corner, and everything looks like rosy-wise. We could see the market behavior and where the money flow is coming out of the bonds into stocks, but also as a hedge into the currencies. We will discuss that tomorrow in why that is the money-wise. So that's in the S&P. Now, if we take the market and we look at things from the standpoint of behavior, If we look at the day, which we just did, and then look at the weekly, you can see the weekly last week reversed last week's behavior, a little larger range to the upside. It's a positive event to the market, which led to the reaction that we see here. 28.18 to 28.24 will be an important market for the market aspect to accomplish takeout. If we can do that, we can see back to 2000. Okay. Many people ask how the lines are drawn. And lines are very important how to draw them properly from the standpoint of which ones to take. Everybody can connect two lines together, but which are the ones that are proper to connect versus the other ones that may not be so proper to connect? They are correct in a sense until they don't work. But if you're able to get the lines drawn correctly, the roadmap becomes much easier to see. Even though the risk always remains. One of the countries, just a heads up, is that's highest up the most today is the Australian dollar. And the reason that is, I know you don't have the chat room, but the reason, the chat box, the reason that is because Australia is a very, 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 very large trading partner with China. And they like that news. That news is going to happen till later. Crude's been in the news. It's a very geopolitical market. I think it has to do very little with supply and demand, even though they tell you stories about supply and demand. I think it's an economy commodity, and it's manipulated by a game. But nevertheless, we still track it, still trade it. So one of the things at Wyckoff that we like to look at are changes of behavior of markets. That can happen through price, and that can happen through volume. And it can happen with price and volume together. See? So, when we have a market that's bearish, we see this market going higher, then we see a very high volume bar here. It's really a lack of upside progress. The market held up okay. But look at these three bars. What can you say about those three bars? The fact that it's effort versus results. You get effort versus result to the markets. This is very weak demand. We then have an up thrust, which is the opposite of a spring, a move above resistance, back under it, and the market retested. High-end closes in markets that are bearish, that don't show demand, are not usually positive markets. The market then comes back lower, tries to rally. The quality of this rally is poor. The quality of this rally is poor. This bar tells you the market is still weak. And then we come back down again and we form some type of action like this here. And I mentioned in the newsletter that this is a fairly poor reaction to a spring. But then Friday came. And the market basically has consistent volume, not really demand, but this was more of a market that was flat trading range. This is a market almost like a kind of a bearish flag that had an upthrust. This market never had the upthrust here. So the market never really had an edge to sell the market. So this led to the gap higher today as well. So the positioning here of the market not working lower with increasing volume indicated that there was some buying going on there, because that increasing volume, or that good volume, did not push the market lower. So now we are at this level. We have enough cause, or a little cause, built into the market. We draw a line for across from here. I mentioned in the newsletter that I expected a move up to about the 5480 to 5500 area when the market was down here. This market is severely oversold from the standpoint of not having a reactionary rally or short-term rally. We draw that line from those previous highs. We can expect the market to come back at this level. If we draw our lines, I'll just draw that because I just can't not draw it when I see a chart like this. You connect this, you see this action like this. This is your reverse trend line, market-wise. Market comes back down, you follow this reverse trend line. This will be an oversold condition to the market. So then the market then comes to the level, and the market just reacted based upon the news as far as that's concerned. And we can see the market short covering. This may trigger, as the market goes higher, this may trigger the market to get to the point where more buy stops get hit, and sometimes take you higher than what you think the market should get to the level in which the last shorts get out and maybe some longs get into the markets. Okay? So that's crude. Crude has been going up. Crude has been going down when the stock market was weak, indicating a slowdown in the economy. I know that maybe you don't want to, maybe you want to hear it, but actually, crude oil rising in price. When it crude oil rising in price happens to be a good thing, because it shows that the economy is getting better and they can afford the shipping costs and afford everything else as far as that's concerned. So in other words, if you get the market action in the crude oil with a stronger stock market, the crude oil tends to rally with stocks, because they like that if a company has a product that they buy at 2 and they can sell it at 4, that's 100% markup. If that product now worth 10 and they can sell it at 20, it's the same 100% markup. But instead of making $2, they're making $10. And that's a very big difference. Very, very important. So the process is very, very important. and then we'll get very important to see how the market behavior acts. Okay, so that is crude oil. Let's look at the Australian dollar. I mentioned a trading partner with China, and those of you that that have been working with the mentoring and sometimes in the day chat room, you will see that the action. You will know that this is a springboard, spring position. Great market behavior to get along with. A spring previous low, the close is high end, led to the rally here. They obviously knew something in the market's reaction. Let's look at a market like the Canadian, which also does very, very well in this type of environment. They also have that type of behavior, though the Australian dollar was higher in value, or the rally better, because of the trading issue with China. Canada more or less aligns themselves with the U.S., obviously, being a North American country, whereas Australia being, I know obviously they're on continent, but they're in the Asia time zone type of thing. And then we can get to the point to where the market then shows that which one is stronger because of that market. Okay, so this is why you see the Australian stronger. So we see why the market, so the money flow goes into the Australian market versus the Canadian market because of the deal with China, which makes a lot of sense, right? Okay. So that is why we see the crude oil. Let's look at the market like gold. Gold becomes more of a crisis currency. Why do I bring up gold? Because gold is really doing nothing in this environment. So it's more of a crisis. If something crisis happens, gold tends to get a bid. If the market economically is doing better, silver generally gets a bid, tends to go higher. Why? Because silver is a market that is used in industry. Gold is used in industry as well, but not as great. So gold is more of a crisis currency, silver is more of an economic currency. We now see the markets have a situation here in which we have a low that occurred here, and we see the market attempting to go higher. But the point I want to bring up about gold is if you look at gold since November 9th, basically almost a month, the market has basically stayed at the same place in the market, same pricing. So I noticed a bar by bar webinar that we do, but this is extremely important because the market shows equilibrium to the market. This equilibrium to the market is extremely important. So this means why it's important, because when you see a market if you see the markets sideways or at equal prices, then the market is ready for a particular move. So when we want to watch markets that have the Wyckoff principles of cause and effect, sideways markets, sideways behavior of markets are very important to observe. We don't necessarily trade them because of that market, but we do view them as important because of the potential move that will happen to the market. So, when you see the markets breaking with demand or railing with demand or break with supply, this cause will give you the particular count to the markets, which is extremely important because when the potential move occurs, the upthrust at the creek or the spring at the ice most likely will not occur because the market has the potential to move. Outside the scope of things, but I wanted to bring that up. Okay, but remember, the point is cluster closes when the market breaks down and then rallies back up. Okay, very important. Let's talk about the bond market. If interesting, when the stocks start to break, the bonds start to work higher because as money went out of stocks, it went into bonds. It did not have a tremendous reaction, so overall bonds have been going lower. Companies do not want to get overloaded in buying bonds in the overall down market. So we see a market that essentially started to move up. And I want to focus on a more recent action because this is all short covering. I had written in the newsletter this 140.16 to 140.24, 140.104 rather. This was all an area of the market having resistance of retesting resistance area. And we see the results of that. Okay. The market gapped lower today. Only by 10 points, but the market gapped lower. They rolled over, I think that's why. Hold on. It's not as pronounced. This is this rate, right? 140, 140.30. Oh, it's because they broke. Oh, it's because they Friday's action. Okay. Anyway, so we see the market obviously having that gap today. The market actually broke. The reason why this is the market actually broke after, they actually rallied after the close, so it's only down 10. They really closed at 141.17 at 2 o'clock. It's close right here. So it rallied after the close, but then it's why the net change only down 10. Okay. So, getting back to the bond market, we can see a couple things happening here. Selling. These are all kind of distribution activity when the market goes up and has these particular selling tails to the market. And this is one of the reasons why the market has gone lower today. Obviously, the China news also helped the market because it increased the value of stock, and money came out of bonds and into stock. So that is the reason why we see that action. And that is why the gap lower, and this is why the stocks are higher. Obviously, the news facilitated that. But that's the behavior, what happens to the market. So everything really is based upon money, and when people trade, or the large interest trade, the Goldman Sachs trade, or the speculative trade like us trade, it's really important to realize that there are live people behind each particular trade in the market. And there's obviously winners and losers to the market. And our job is to find the demand or the supply and who is winning those battles when the market reacts that way. So it's a very, 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 very important that we understand the dynamics and how the market accepts prices or the market does not accept prices. When a market runs away from price, it is not accepting that price. When the market stays at that price, in other words, like cluster closes near a high or cluster closes near a low, or just cluster in general, the market is some type of equilibrium. It is accepting those prices, and that means that the market ultimately, it's very, very important because a particular move will happen. So we want to really be at a level to understand what reading the tape is. And I would say that very few people know how to read the tape better than a person that studies Wyckoff. Every successful trader and business-wise understands price relative to volume. They may not call it Wyckoff in their mind, but that's exactly what they're doing. That's exactly how they're behaving with the market. So essentially, they understand price and volume without really knowing the schematic of Wyckoff by looking at the chart, but they understand the schematic by market behavior and market action. So it's very important to see how the market accepts prices, and very important to see how the market does not accept prices. Very, very important. Okay. So, when we look at the behavior of markets and we see the particular news that happens in the market, if it's bullish news or bearish news, it affects the price of the market, obviously. And those who are looking at the market, oh, that's bullish news, buy it. Or that's bullish news or bearish news, and sell it. What ends up happening is that the market gets initial fear and greed of a particular news item. And my experience is that you want to wait like a half hour to see how the market reacts to that behavior. So it's not the news that's important. It's how the market gets affected buy the news. It's extremely important in how markets behave, and again, how the market accepts or doesn't accept those prices. So, when we look at the market and we see the market, it's very important to see how the market reacts to that. And the reason why that is because we do not know as traders what is bullish or what's behind a particular move or not. We just know that the market has double earnings or triple earnings, but we don't know how the market necessarily is going to react to some particular news.